Good evening, VectorVest Nation. Ron Wheeler here, and it's my pleasure to bring you tonight's special presentation, Providing Income in All Markets. Now, we at VectorVest believe that every investor should be using this 3P model. Now, this is part of the Ultimate Retirement Solution Group Coaching Program, but ultimately, no pun intended, this is something that everybody should be doing as an investor. And it's, again, the 3Ps. On one side, you have the profit model. Profit really comes down to building a good portfolio of stocks, rising in price when the market's rising. So the core of your investments, probably where most of your investment dollars are. Another aspect of the 3P model is the preservation. That's at the bottom. Preservation meaning exit trades when they're going against you, when the market turns, exiting those bad stocks, weaning those bad apples out of your portfolio, and then also learning how to hedge things, earnings trades. You know, when you have a stock that has earnings coming, maybe buying a put to protect your profits, maybe overall portfolio hedging when the market goes into a confirmed down. It doesn't really make a difference at the end of the day how you preserve, but we don't want you losing money when the market turns against you. Now, the aspect or the third P that I want to talk to you tonight about is the provide model. Provide is using your investments as income devices, if you will. So in the provide model, there's a couple things that we do. Number one, we call this income trading. And before I get too far, I just want to talk about what is an income trade. Well, an income trade is a trade that has a statistical probability of making money over 50% of the time. Not because you got a new fancy indicator, not because you found the best trading system in the world. It's about the statistics, history, setting the trade up where when you run the numbers, the trade has a statistical probability. Now, what are types of these income trades? And I believe that you should be doing all of these in your portfolio. Number one, stocks with dividends. Now, I'll be honest, I'm not much of a stock trader. I like to do options, and options are my thing. But when I do invest in stocks, and I have stock investments now, I like to buy stocks that have dividends. Because dividends will give you yearly income, quarterly income, however the stock pays dividends, and it does it regardless of what the stock does. If the stock goes up, dividends are great. If the stock goes down, dividends can offset the losses in those stocks. So dividends come no matter what. There is a near 100% statistical probability. And I say near 100% because dividends can end also. But buying the right dividend stocks with a good history of dividend, and hey, you got the best platform for that with VectorVest, this can be almost assured. Covered calls. Covered calls is selling the right to your stock to someone else at a higher price. I love covered calls. I love dividend stocks. Guess what? Doing a covered call on the dividend stocks is like double dipping in income. It's a great thing to do. Now, with those first two income trades, there are some disadvantages. Number one, it's expensive. You have to have a lot of capital typically to do a covered call or buy stocks with dividends. But there's room for those in every investment portfolio. Now, what I want to talk to you about tonight is option-only trades. Now, the cool thing about an option-only income trade is that these are very, very easy to do. They are very inexpensive to do, and they are very, very low risk. And I've been doing this now here at VectorVest for, almost a decade. It'll be 10 years in February, actually, since I've been doing these types of trades here at VectorVest. And tonight, I just want to share with you what we do to look for these. Now, what I'm going to focus on tonight is bearish. Now, I know you might be thinking with the current market, but Ron, the bearish trend is over. It's possible the bearish trend is over. It's okay. We focus a lot on bullish. But I want to help you focus on what happens when the market turns bearish, because a good income trader in a big piece of that provide model is to draw income even when the market turns against you. So we may be out of this downward move of the market. We'll take a look at that in a second. But I want you to be prepared for what happens the next time, or if all of a sudden this downtrend continues. That's my goal for tonight. So let's break this down a little bit. What are the steps for income trades? Well, number one, market direction. We want to make sure that the market direction is actually going down when we do these bearish trades. We only do bullish income trades when the market's going up. We only do bearish income trades when the market's going down. Then the second thing we're going to do is find the right stocks for this. Not every stock is a good income stock, so we want to make a few modifications, and I'll show you what scans that I like to use in VectorVest to get us there. And then third is the setup of the overall trade. So let's jump right into this. Now, also, while you're looking at some of these slides that I'm going to be using here in the next however long the presentation is, I also want you to know that I'm pulling slides directly from the Options Paycheck course. So this is kind of a preview of what some of the material looks like in the Options Paycheck course. But it's a lot of stuff that you can learn tonight as well and take that with you. And I'm also going to use a real-life example of a trade I took about a week and a half ago when the market was still in the midst of that downward move. So I'll use an example of a very recent trade. So the first thing I like to do for market direction is simple. I open the VectorVest market timing graph and I look at the DEW. Now, for income producing trades, I like to look at some of the longer term market timing tools, whether it's a confirmed down or a DEW down. I like to use those. So let's take a look at VectorVest real quick, and let's take a look at the current market. Now, this is Friday at about 11:30 in the morning. As you can see, the market is up very strong today. And in fact, we got a couple of green lights recently here in the color guard. So again, we may be looking at a situation where the market downturn for now is over. And that's okay. I'm not saying you should run out there and do bearish trades, but I want you to be prepared for when the next bearish comes. Because there's one thing I've learned over my 27 years of trading. When the stock market is going up, everybody's an expert. But to make money when the market is going down, that's what separates the all-time winners from the losers, if you will. Okay, so let's go to a timing graph, and I'm going to look at a market timing graph, and let me drag that over to my main screen here. There it is. And let's take a look, and I like to use the do. Now, the confirmed call, we're obviously still in a confirmed call down, as you can see right here. That would be an indication that you could use bearish trades, or if you want to be a little more aggressive, you can use the DEW. And here's the DEW right here, and we entered into a DEW down back on December 17th, and we've been there ever since. Now, in the spirit of disclosure, let me go ahead and go to a graph layout here. I'm going to open up the Pro Trader Timing DEW. We are close to ending this DEW down. We're well above the moving average, and the DPO is getting close to overlapping zero, which would be a DEW up. Again, I'm talking about, okay, maybe this is the end. Or who knows, maybe next week the market sells off another 4%. You never know. But this is something I want you to do when the DEW is down. Okay? So DEW down, we do our bullish or bearish trades. DEW up, we do our bullish trades. So once we have the market direction pinned down, we're going to use some stock selection techniques. Now, in VectorVest, there's a whole folder of this. If you go into VectorVest and into the Unisearch, you're going to look for a folder called Searches Short. So let's do that. Back into VectorVest, I'm going to go to my Unisearch, and look at that. It's already highlighted. Maybe it's telling me something. Nah, I'm just kidding. I highlighted it earlier. Open up Searches Short. There are a ton of short searches. Now, the one that I like, and this is just, my favorites, I happen to like the one that I'll choose for tonight, is I like Pirates. Now, why is Pirates one of my favorite? Well, I like earnings. Earnings are the driver of stock performance, right? Earnings per share, earnings yield, earnings growth. Well, Pirates, one of my favorite things about it, if you look at the comments, find stocks above $10 that are either a sell or a hold. That's cool. This sort will bring the stocks with negative earnings yield to the top. That means earnings are poor. I like that. That's a good thing for a bearish trade. Now, if I run that search, this is pretty much what I'll find. Right here, we have a ton of drug stocks. Now, I don't like trading drug and pharmaceutical stocks because different announcements can come out and sometimes they're too prone to whipsaw. I don't like that. So what I've done is I've modified that search a little bit. Now, I'm going to go into my folder and I'll explain to you what I do to that search. I'm going to run the scan Pirates short, but I've done some modifications to this scan. What I've done is I have only now looked for stocks that are moving down, okay? So they have to be down for the day. I'm looking for stocks that are lower over the last year, lower over the last month, 3 months, pardon me. And I'm looking for stocks that are not in the pharmaceutical industry. I don't like trading farm stocks. They tend to move around a lot, and it can happen with no rhyme or reason. So income should be about safe and secure. Okay, so I do like that scan for Pirate short. Now I'm just kind of curious, if I stream this and I run the scan right now, am I going to see any stocks today? And by the way, I like it where there's no ETFs in there. I don't have a problem with trading ETFs. One of the problems that I see typically with this scan is it comes up with a lot of bond-related ETFs. So I tend to not like those. So I generally won't use those. So Pirates, short, no ETF. And then you can even see on a big day like today, I still have 5 stocks in that scan. Good, it's a perfect thing. Now, just to give you a look at a stock and what these stocks would look like even in a big day like today, I'm going to go ahead and graph those real quick. And you can see that this stock is definitely poor performing. You can go down. JB Hunt not looking too good. This stock is, I don't know, that's all over the place, into it. And Tidewater definitely moving down as well. So that's the kind of stocks. Even though the market's been pretty much uptrending all of 2024 with a few exceptions, these stocks are really poor performing. So the next step once you find the stock is to set up the trade. I use an option spread called a bear call spread, and we'll talk about the benefits as we kind of go through it. But in setting up the trade, you need to be selling an option. There's going to be a short strike involved. That means the strike of the option you sell. There's going to be an insurance strike, so you're not selling a naked option. We have to think about expiration, projected loss, the number of contracts. We got to make sure our portfolio risk is in line. So I can't cover all of these in tonight's presentation, but this is kind of the whole package of what needs to be considered as you're setting up these income trades. So based on my experience and based on the testing of a lot of trades I've done in the past, these income trades that we set up typically occur in about 7 to 10 days. So what we're looking to do is set up a trade that gives us at least a 60% base chance of success with only a 40% projected loss. So if I take 100 trades, theoretically I should win 60 and I should lose 40. Okay? Now, what happens is I'm going to look at the current stock price, which is right here, right down there, and then I'm going to choose a price above that stock to where it says the market can go down, sideways, or up, and I can still win. Hence the idea of income and statistical probability. Now, over the next 7 to 10 days, what happens if the stock does go up? What happens if, the stock didn't go down like I thought it would do, it actually went up? Well, remember, we got to think about an exit plan too. If the trade doesn't go down and goes up, we're going to exit that trade at a loss, and we're just going to move on to the next trade. Now, the trade that we use is called a bear call spread. So we're going to use calls. Now, this trade, 2 options at one time. We're going to sell a call that gives us greater than 60% chance of winning, less than 40% chance of losing. Then in the same transaction, we're going to buy a call because we don't want an unlimited risk. Okay? That call that we buy, we refer to this as insurance because it protects you. And I'll explain why it protects you here in a few minutes. Now, how does this trade work? When you open the trade, when you enter it, you're going to get paid. Okay? You're going to sell a call. You're going to collect money. You're going to use some of that money to buy a call. That's going to cost you a little bit. So when you sell the option to open the trade, you get paid. Where does that come from? It comes from you're selling the call. You receive more money for the call than it costs to buy the insurance. In other words, you're going to receive money to place this trade. So let's do this. I want to show you an actual trade that I took back on January 6th. It was Palo Alto Networks. And I want to kind of walk you through how this trade came about. All right, so let's go back to VectorVest and January 6th. Now, really quick here, I want to go back on the market timing graph. Let's go back to January 6th. January 6th was right about here. And you can see back on January 6th, and let me kind of zoom in on the graph a little bit. Here was January 6th. We were actually up that day on the market timing, but we were still in a DEW down. I have no problem placing bearish trades when the market's going up for the day, as long as the overall trend is down. And then you can see over the next couple of days, the market did go down a little bit further. So I'm going to go back to my Unisearch, and I'm going to run that Pirate Short No ETF, and I'm going to run that back on January 6th. So let's choose January 6th, click OK. Now, January 6th, why January 6th in particular? Well, it's a Monday, and I happen to have a live coaching group on Monday, my URS coaching group. So I look for trades on Mondays. That's why we happen to do it this day. But you can do it Tuesday, Wednesday, Thursday, Friday. It doesn't make a difference. I just happen to do it live with my coaching students that day. Let's go ahead and run the search. So here's a list of stocks that came up that day. And as you can see, the top one on the list was Palo Alto Networks. Now, there was also a couple on the list that, Mondelez, that actually, I took that trade as well. That trade worked out pretty well. I also took Medtronic. That trade worked out pretty well as well. So there was a couple trades here. But I also just want to look at Palo Alto Networks first. So if I right-click on that, let's take a look at the actual graph. This is back now on January 6th. Let me zoom in a little bit here, and let's go back to January 6th. Okay, so here's January 6th. I like the stock. It's down for the day. It's past a level of support. There's really nothing below it that can hold this thing back. That's the kind of stock that I like to look at. And you can see over the year, it was just on January 6th back here, it was down for the year for the most part. And then, this would be a year. It was also down over the last 3 months. Okay, there was no support for a while. That's a trade that I like to do. So what I'm going to do is I'm going to now choose an option. So I'm going to go to an option chain, and this is back from January 6th. Now, a couple things I want to show you. I like to set up the trades with a less than 40% probability of losing. There's a number in option statistics that give you this. In our Options Pro program, it's called ITM. And most brokers, it's called this too. That's the probability that this stock goes in the money. Now, what does that mean, in the money? Basically, it means that the stock price has surpassed the strike price of the option, either up or down, depending on calls or puts. These trades that we do are out of the money, and we want the options to stay out of the money. So if I look at an in the money chance, and I look at a 56% chance, that would mean if I sold that option, I would have a 56% chance of that trade going against me. That's not good. But if I sell this guy right here, 37.4%, that means, and if I go over to the right, the 185 strike has a 37% chance of finishing in the money. Okay? If it stays out of the money, I win. It's got a 37% chance of failure, a 63% chance of winning. Okay? Now, at the time on January 6th, the stock was $179.50. 185 gave me about, what is that, a $6-ish, $5.50 room to have this stock move. Okay? Now, what I also have to do in this trade is I have to go out usually one strike up, and I'm going to buy my insurance. Now, very quickly, what this does, when you sell a 185 call, that gives you the obligation that you have to sell the stock to somebody if they want it. Now, only about 6% of options ever become stock trades, and that happens at expiration if you let the option expire in the money, which we never would do. But I want to protect myself. What happens if the stock makes a tremendous move up and now all of a sudden I got to short the stock at 185? That means I have to go out there, buy the stock at whatever price it is, and sell it to somebody else. Now I have a short position. That's not good. I go out there and buy an insurance policy, in this case at 190. When I buy a call, it gives me the right to buy the stock. So theoretically, if this trade went way against me and I have to sell somebody the stock at 185, what if the stock's at $200? Now I have the right to buy the stock for 190 and I can sell it to my option buyer at 185. Now, that might be a lot to swallow. Let me explain. I've never done that before. in 15 years of trading option spreads, I've never actually had to do that, okay, in one of these spreads. So don't get obsessed with that. We use that 190 as disaster insurance. It protects us against volatility, and it also provides a nice little hedge just in case the trade goes against us. Now you can see at the end of the day on January 6th, the 185 was trading for about $8.10 roughly at the midpoint of there, and the 190 was trading for about, we'll just call it about $6.40. Well, here's what actually the trade was. When I took that trade during the day on January 6th, okay, I sold the 185 call for $7.55. So if you sell one contract of Palo Alto Networks, the February 185 call, you would receive $755. Okay? I bought the 190 as insurance, and it cost me $575. This is done in one transaction. The net result of that trade means I collect $180. So when I enter the trade, I get paid $180. Now, what I want to see happen is the stock to move lower. If the stock moves lower, this is what's going to happen. That original call that I sold for $755 is now trading for $335. I can exit that trade by buying out my obligation for $335. Well, I sold it for $755. If I buy it back or exit for $335, that's a win. When you're a seller, you get all the money up front, and the idea of when you exit the trade is to exit at a lower price. Now, here's the downside, and I'm using air quotes, which of course you can't see. I bought the 190 call for $575. Now it's only trading for $245. That trade right there is going to be a loss, okay? But the net result of that is $755 minus $575 was the $1.80 or the $180. $335 minus $245, that results in a net of $90. So I exit the trade and I can make a $90 profit, okay? Now that's $90 per contract. Doesn't sound like a lot, but these trades do scale. So the net result of that trade was a $90 per contract win. Now, I took the trade with 8 contracts, and you can see here from Thinkorswim, I entered the trade on January 6th at 15.25, so I think that's 325. I exited the trade on January 13th at 11.31, and you can see the opening transaction, I collected $1.80, and the closing transaction, I paid my broker back 90 cents. That means I get to keep 90 cents or $90 times the 8 contracts. And you can see, we can just go back to the graph of Palo Alto Networks, and you can kind of get an idea here that, bear with me a second, I got to get back to my graph. There we go. Nope, that's not the graph. That's the graph. And you can see, look at that, Palo Alto Networks has actually made a big turnaround. But from January 6th, which was right here, down to the 13th, that stock did exactly what I wanted it to do, and then it finally turned back up. So the beauty of this is you're in and out in an average of 7 to 10 days. You're not giving the market a ton of room to go against you. And again, the concepts for what you just saw are a glimpse of what we do to provide income in bearish markets. Now, just a quick review. Step number 1 for this, establish market direction. If the dew is up, we trade bullish. If the dew is down, we trade bearish. Stock selection. Use VectorVest. It's the best stock picking tool I've ever seen in my 27-year career. Use those stock selection tips. Trade setup. We're going to sell options typically 21 to 45 days away in expiration. We're going to sell an option. We're going to sell a call for bearish markets that has a less than 40% chance of finishing in the money. And we're going to identify those for the next 7 to 10 days. We're going to exit the trade when it hits about 50% profit. These are the initial steps for collecting income when the market is bearish. So if this is something that is intriguing to you, if it's something that's missing from your portfolio, I want you to keep an open mind. Options are very, very simple. And I may have gone over some things tonight that maybe you didn't see or you've never seen before. Maybe we're a little confusing. That can happen. Keep an open mind. Now, next week, we have seats open for our free live online workshop for the Options Paycheck. Go to www.optionspaycheck.com. And if I go to that site really quick here, I'll go ahead and click on reserve my seat. And you can see next week we have 3 courses or 3 classes. They're about an hour and a half long at noon, 5, and 4:30. If this is something that's missing from your portfolio, jump in there, take a look. We've been doing this course. It's one of our more popular courses here at VectorVest for, again, almost 10 years. And we really, truly believe that this is a very important part of that 3P investing plan. Learn how in 2025 to be prepared for, while we talk tonight about bearish markets, be prepared for all different types of markets. And the beauty about the Options Paycheck course is it's not just options. We teach you how to find the right stocks. We teach you how to identify market direction. We're going to teach you from the ground floor, even if you've never had success with options. So again, keep an open mind. Come to www.optionspaycheck.com. Get yourself signed up for one of our information webinars this week and learn how to add that P, that last P, to your portfolio. Thanks for watching tonight. We'll see you next time. Take care, everybody.